It's my great pleasure to say a few words about Sheridan Titman before he delivers this year's presidential address. Since 1997, Sheridan has held the McAllister Centennial Chair in Financial Services at the University of Texas at Austin. Before that, he held faculty appointments at UCLA, Hong Kong University of Science and Technology, and Boston College, serving as vice chairman of the faculty at both UCLA and Hong Kong UST. And he worked in Washington, D.C. as a special assistant to the Treasury Assistant Secretary for Economic Policy. He has served as an editor of the Review of Financial Studies and an associate editor of many journals, and he's a former president of the Western Finance Association. His publications include roughly 80 academic articles and 2 books, and his research has garnered numerous awards, including a Smith-Breeden Prize. Sheridan's scholarly contributions are impressive in many respects, but perhaps most impressive is their breadth. It's rather uncommon in our profession for someone to make major contributions in both corporate finance and asset pricing, but Sheridan has consistently done so throughout his career. Indeed, of Sheridan's 10 most cited articles, 5 are in corporate finance and 5 are in asset pricing. It's also uncommon for someone to make both empirical and theoretical contributions, but here again, Sheridan's work includes notable examples of each in both corporate finance and asset pricing. He's also made significant contributions in the field of real estate, and more recently, he has turned to energy, heading his university's Energy Management and Innovation Center, as well as blogging on energy policy. Sheridan is truly a man for all seasons within our profession. There's not time even to list all the topics on which Sheridan has worked, but I'll mention a few highlights. In corporate finance, Sheridan has had a long-standing interest in capital structure. One focus of this research, both theoretical and empirical, is the role that various characteristics of a firm play in conflicts among stakeholders of the firm, and in turn, the roles that such conflicts play in determining dynamically changing target capital structures and the speed with which firms adjust to those targets. In asset pricing, Sheridan's contributions include fundamental work in measuring mutual fund performance, as well as challenging the adequacy of risk-based explanations for the cross-section of average equity returns. In fact, probably the most prominent challenge to risk-based explanations that we have is still the momentum anomaly carefully documented in Sheridan's 1993 JF article with Jagadish. In preparing to introduce Sheridan, I asked a number of folks in the profession who know him well if there was anything in particular that the rest of us should know. I got a very consistent answer. Sheridan is a superb colleague. I suspected as much just from his CV. He has worked with lots of co-authors. I got curious as to just how many and quickly discovered I needed Excel to help me count. I got 54. But what numbers don't reveal is his generosity with his time and his loyalty to colleagues. As for loyalty, I was particularly struck by an example Mark Grindblatt recounted from the 1980s. The discussion of Mark's tenure case at UCLA happened to coincide with the birth of Sheridan's first child, Trevor. Sheridan left his wife, Meg, in full labor to speak to the faculty about Mark's case, favorably, of course. Not only did Mark get tenure, but he's also relieved to report that Meg and Sheridan not only still speak to each other, but remain happily married. The other trait mentioned by Sheridan's colleagues is his willingness to learn by asking questions with no concern for revealing any lack of knowledge in the process. One of his longtime collaborators says part of what makes Sheridan such a great colleague is that he actually seems to do most of his learning by talking. Well, it's time for him to talk, but I'm quite sure that we will be the ones learning. I'm very pleased to introduce this year's AFA President, Sheridan Titman.
Thank you very much, Rob. Very nice introduction. Give you an A for for covering all the highlights and maybe a little bit lower for managing expectations. Like a lot of people in our profession, since the financial crisis of 2008, I've been thinking quite a bit about policy lately. Okay, this has forced me to think a bit more about macro. That's a topic which is relatively new for me. And in addition, think more about externalities in general and about investment externalities in particular. In particular, wanting to think about when we're going to get underinvestment versus overinvestment relative to the social optimum. Okay, my thoughts on over versus underinvestment, none of that is particularly new. Okay, but what I want to think more carefully about is how shocks to financial markets are going to interact with these investment externalities. Specifically, my main message is that the financial market shocks can either enhance or mitigate these investment externalities. Okay, in some cases, a shock can move us away from the first best in the sense that I have overinvestment and the shock can cause even greater overinvestment. Okay, but in other cases, the shocks can mitigate the effect of the externalities. The other point is that these shocks are going to be different depending on whether these are shocks to the debt markets versus shocks to the equity markets. Debt and equity market shocks are different. And finally, what I'm going to be thinking about is the interaction between financial market shocks and investment externalities, to what extent they can explain some of the stylized facts that I've been recently learning about from the macro finance literature. Okay, there's a whole host of ideas and influences that I will try to cite in more detail when I actually get around to writing this up. But for right now, I just want you to know that I didn't discover all these ideas on investment externalities on my own. There's a big literature. And also, of course, there's a big literature on imperfections in the financial markets. Okay, in particular, I'm going to be building on this sort of Grossman and Stiglitz type framework where we've got what I'm going to be calling participation shocks, which I'll be defining in more detail as we go along. And of course, information asymmetries. Some people are more informed than others. And together, because we have shocks to participation and shocks to fundamentals, there's going to be an inference problem, and we're going to have a noisy rational expectations equilibrium. Okay, the other thing I just wanted to note was, although I'm very influenced by the behavioral literature, and I'm going to be saying a lot of things that have sort of a behavioral tinge to them, okay, the people in my models, okay, the players in the story are all perfectly rational. Okay, so this is a story with everyone's rational, okay, but I want to emphasize these are rational people that sometimes make mistakes. Okay, and these types of mistakes are going to be important in thinking about the equilibrium. Okay. Just very briefly, I'm going to be talking again about investment externalities to start. I'm going to review some of the stylized macro finance facts that at least I find interesting and which I'm going to try to address. I've got a model. The model that I'm going to be talking about isn't something I've done independently. This is a model that I've been working on with Subra. And finally, I'm going to speculate on why shocks to debt and equity markets can be different. Okay. So we're going to start with two very simple, what I'll call stylized models. They're really examples. Again, there's nothing new in models per se. Okay, but I want you guys to pay a little bit of attention, even though these are simple, because I'm going to build on these later in the talk. Okay, the first model is what I call the catalytic model. Okay, the catalytic model is a story about an investment. I'll use an example of the internet, which is a catalyst for other investments. Okay, one way we're going to think about it is this is an investment that's a strategic complement to lots of other investments that complement other investments still. So it's sort of three levels of complementarity that characterize this catalytic model. Okay, the second model is what I call the pecuniary model. Okay, the pecuniary model is a model where the investment affects price, okay, but then the price affects other decisions that themselves have externalities. So again, that should be clear as I go along. Again, I won't try to claim that these models are new, but you should pay attention because I think they will be used later for things that might be of interest. Okay, so the catalytic model. My example here is the internet. So date 0 of the model, we have a new invention. We'll call it the internet. I'm not sure who we'll give credit to, but we'll say we've got AOL, Yahoo, and Netscape are born in 1995. Okay? In the next period, you've got different types of investments that complement the original internet investment and complement each other. Okay, so you've got companies like Cisco and Broadband.com that are basically doing the guts, the infrastructure of the internet. And then you've got the e-commerce companies like Amazon.com and E-Trade that are basically utilizing these pipelines. Okay, so the idea is that these investments are all strategic complements, okay, which again means that the more that Cisco invests in the pipelines, okay, that's going to imply more investment by Amazon.com, and the more that Amazon.com invests, it's going to lead to more investment by Cisco. So these things build on each other. Okay, these are the strategic complements, but it's also important that there's these sort of old line brick and mortar companies that are actually hurt by the internet. Okay, so these are companies that the more Cisco and Amazon.com invest, the worse off they are. So these are the old-time bookstores, Borders Books, newspapers, travel agents, you name it, all sorts of sort of old generation firms. These guys are being hurt by the Ciscos and the E-Trades and the Amazon.coms. Okay, so the point is that we've got lots of externalities in the investment, and depending on the strengths of the strategic complementarities versus the substitutes, you're going to either have overinvestment or underinvestment relative to the first best. Okay, in our catalytic model, at least the way I'm going to think about it going forward, is that we're going to assume that we like encouraging these emerging investments. Emerging investments are a good thing. We like the idea of creative destruction. The idea of we've got new innovations. These are complementary. They feed on each other, but they destroy the old. And overall, that's good for the economy. It doesn't have to be the case, but that's what I'm going to be assuming as we move forward. Okay, so that's the catalytic model. Okay, the pecuniary model. Okay, the pecuniary model, I'm going to illustrate it with a real estate example. I think it's going to be clear why I'm choosing a real estate example in this particular case. Actually, the reason why I chose that is the reason why, in general, I start with real estate examples. They're easier to think about. If I can understand a concept using a simple bricks and mortar real estate story, then I can generally extend it to something else. Okay, so this story is, again, a story about supply and demand. Okay, if I build more houses, then obviously the price of houses will be lower. That's the idea of a pecuniary externality. You build more, prices are going to be lower. Okay, now a pecuniary externality on its own is no reason for policy. I mean, this is true of everything. So our policymakers aren't going to keep us from making, growing more corn because that lowers the price of corn and that hurts other people. But the pecuniary externalities do have bite in policy circles if the price change is going to affect other decisions, and those other decisions have externalities themselves. Okay, so the way this model works is at date 0, we build. Okay, date 1, okay, we get a shock. Okay, we could say that we've got a boom or a bust. You've got a positive shock or a negative shock. And I want to think first about the case where we built two little houses relative to the shock. So we've underbuilt in some sense and we have a boom. The question is, we know that the prices are going to be higher. The question is the higher price going to spill over any sort of externalities at all? And the story that I'll be telling is that there are positive externalities associated with a higher price. There's a big literature in the urban economics literature that basically says, well, if people have houses that have higher values, they're more likely to maintain the houses. If I maintain my house better, that improves the value of my neighbor's house. That's a positive externality that's important. The other externality, which I think is quite interesting, is there's a literature that says that if I live in an area where the housing prices are going up, then the individuals in that area have more wealth, and they use that wealth to start businesses. Okay, so the basic idea here is that most new businesses are funded by individuals that borrow on their home equity loans, and they're able to do that if the prices are higher. Okay, so we've got a couple reasons why there are positive externalities associated with high prices in housing, which is a reason for why we would think that there's a positive externality associated with producing less houses. So in some sense, we might want to worry about what I'll call this overbuilding phenomena, because an underbuilding phenomena might be better. But let's talk about the overbuilding case, and that's the case where there's too many houses relative to the shock. And now let's say that I built a lot and I get a negative shock where there's low demand. That's going to mean low prices. Okay? What's the externality associated with low prices? Well, in some sense, it's the opposite, the mirror image of the positive externality with high prices. The only other thing that I want to add is that in addition to neglecting maintenance, there's a literature that talks about the fact that, you know, if there's broken windows on your street and the houses are falling apart and people are foreclosing, okay, crime rates in the areas actually increase. Okay, so in addition to the lack of entrepreneurial activity associated with the high prices or the low prices, you actually get increases in crime when housing prices are low. Okay, so this is a case where we've got externalities, positive externalities associated with high prices, and negative externalities associated with low prices that would lead policymakers to, in some sense, be concerned about what we'll call this overbuilding phenomena. Again, this isn't necessarily new for me, but this is going to be something that I'm wanting to build on as we move forward. Okay. So again, in the pecuniary model, we get overinvestment in housing. Okay, the externality arises because the housing investment affects price, and the price affects other decisions that generate externalities. Okay, it's also clear in this particular story that we get underinvestment in maintenance because maintenance itself is a strategic complement. Okay, if I maintain my house better, it's going to lead to my neighbor maintaining his house better as well. And again, it builds on each other. And the other thing I just want to mention is there's this what I call unfortunate snowballing effect when you have too much complementarity. Again, the macro guys will call this a coordination failure. But what I'm worried about is that if there's a lack of maintenance in my neighborhood, that causes the price to fall further. Okay, the fact that you've got a further decrease in price magnifies this under-maintenance problem, causing even more, declines in prices. And to the extent that's going to increase the crime rate in my neighborhood, it causes even more decreases in price. So the point is, we can be in situations where you've got, in some sense, a tipping point, where a small decrease in demand can cause a drastic decrease in prices because of all these externalities. Okay, the reason why, again, this is important in general and not just an issue for housing is it's a way to think about volatility in stock prices or anything else. If you've got tipping points where the prices are going to affect decisions that adversely affect prices and so on. In those situations, you've got particularly fragile prices and high volatility. Just wanted to note that, again, I like to think about all these issues starting with housing and real estate because they're simple, but these are generally ideas that can be extended to lots of other things. As Rob mentioned, I've been thinking a lot about energy lately. So the general example that I've been thinking about is the example of excess capacity in what I'll call incumbent technology. Okay, so if I've invested a lot in the old technology, then I've got excess capacity in that technology. That's going to keep prices down in the old technology. That's going to stifle innovation in new technologies. So the example that we see today is that there's a glut of capacity to produce photovoltaic solar cells. Okay, that's the old technology for solar energy, the PV solar. There's a glut of that capacity, and because we have a glut of that capacity, the firms that are in the U.S. that are developing thin film solar, which is sort of the next generation of solar, they're all going bankrupt because of the low price of PV solar. Okay, so this is another example where we've got low prices. Okay, the low prices affect decisions that themselves have externalities. Okay, so we have less innovation in the new technologies because we have too much capacity in the old technology. Okay, so I think that's something that's worth thinking about. Just a very quick aside on sentiment, and I don't want to talk too much about it, but I just wanted to mention sentiment because it's kind of implicit in these types of stories. One thing that I want to emphasize is that there's a lot of stories about the fact that in times of new technology, people seem to be overly optimistic, and people have used that to talk about things like the internet bubble. Okay, one thing I just want to mention is causation goes both ways in these types of models. Okay, one can tell the story that the new technology is successful because of the optimism, rather than the technology causing the optimism. Okay, you need people optimistic about the technology for them to do the complementary add-on strategic complementary investments. So we may have observed a lot of sample paths where we had a new technology that would have been great if people would have been optimistic, but because people weren't optimistic, the technology never took off. And so we didn't observe that sample path of new technology and pessimism. The other thing I just want to, again, emphasize is that none of my stories going forward rely on sort of this multiple equilibrium notion of sentiment. Okay, so it's something that we're thinking about, but that's not a required assumption for anything that I'm going to be doing going forward. Okay, I want to switch a little bit into macro. Again, this is the area that I've learned about this year. Some people will question some of these facts, but this is sort of my reading on the facts. And what I ultimately want to do is come up with stories that explain these facts. The first fact is that stock returns predict aggregate economic activity. Okay, so there's a lot of papers where they're doing various things like regressing stock returns or price to dividends or whatever on future growth rates in the economy, and there's a significant relationship there. Okay, the second fact is that stock returns on the aggregate tend to predict investment. Okay, so when the market goes up, firms tend to invest more. Now the third fact, and this is one I'll talk a little bit more about because I find it a little bit counterintuitive, and this is what John Cochrane emphasized in his presidential address a couple of years ago. That's the fact that returns and price levels don't seem to predict changes in aggregate dividends. Okay, so when stock prices are high relative to dividends, that does not mean that dividends are going to go up in the future. What it actually means is stock returns in the future are going to be low, which is the fourth fact, which, and here I guess I'll add my own opinion, is that stock returns seem a bit too predictable. at least ex post if you look at the sample path. They're too predictable relative to things like the price-dividend ratio or consumption-to-market value ratios, the K variable. Of course, we can get models, and in our model you can get predictability from these ratios. Okay, but my claim is that for what I would consider plausible utility functions, the level of predictability is too high. Okay, so these are the facts that I view as challenges that we want to think about a little bit more carefully. Oops, okay, let me just explain why I'm particularly confused about the fact that stock returns predict aggregate economic activity but don't predict changes in dividends. Okay, so I'm going to start with how I learned this in Econ 101. And basically the Econ 101 story is that, again, first, the stock market is forward-looking. Okay, so think in terms of a world with a forward-looking stock market. Okay, the market sees that macro output is going up, and the reason why the stock price goes up when macro output goes up is because there's a tendency for firms to increase their dividends when the macroeconomy is doing better. That's basically the story. The story is really based on the fact that there's a link between dividends and stock prices just from the simple present value mechanical link. Okay, so again, the story is macro output is expected to go up. That means dividends are expected to go up. Because of the present value relationship, stock prices are going to go up. Therefore, stock prices are forward-looking and predict future macro output. Now, the problem with that story is, as Cochran emphasized in his talk a couple of years ago, stock prices do not predict dividends. Okay, so once we are able to live with the fact that stock prices do not predict dividends, then I have to go back to whoever taught me Econ 101 and tell them I no longer understand why stock prices predict macro output. Okay. Now, the question that is raised by this is, that's a story of stock prices reflecting the future. Okay, and that's sort of the way, at least I was taught finance in Finance 101, is stock prices reflect reality. They don't, in some sense, cause reality. Okay, so we want to think a little bit more carefully here, given that I can't explain the relationship between stock prices and macro output, where it's the output that causes stock prices. Maybe I can explain these facts in an environment where it's actually the stock prices that cause the macro output. Okay, does that make sense? Okay. Also, and this is a more recent literature I just wanted to mention. This is literature about credit markets. And the facts here are that in the short run, wider credit spreads tend to predict economic downturns. Okay, we don't have any problem with that in terms of our traditional way of thinking about financial markets. Okay, that's just a story where the credit spreads go up when we think the economy is about to tank. Okay, obviously the economy is riskier, so credit spreads should be wider. So that's not much of a surprise. The one that's harder for me to understand, and you're seeing that in a lot of popular books now, is this idea that credit booms tend to precede financial crises. Okay, so that's a much more complicated story where, for some reason, we have easy credit spreads narrow, firms lever up, the levering up causes a problem, and then we see the problem, and then the spreads widen again. So that's a very complicated, sort of convoluted story. Okay. As I mentioned, I read a few macro papers this summer. So I'm just taking quotes from 3 papers that were published within the last few months. This is the view of the macroeconomists, and I think it can be summarized by Roger Farmer's title of his paper, which was "The Stock Market Crash of 2008 Caused the Great Recession." Okay, so clearly he's not hedging his bets here. Causation runs from the stock market to the real economy. So the real economy isn't something that's reflected in the market. The market actually causes the real economy. And these other two papers that just came out recently in the AER, those are papers that are talking about shocks to credit markets causing something happening in the real economy. So it again is a shock to the market causing the real economy rather than the real economy simply reflecting, being reflected by the financial markets. Okay, so the way these guys are thinking about it is very different than the way we thought about finance in Finance 101. Okay, there's a lot of questions that are raised by this. First off, what do we really mean by cause? If you read this literature, I guess I'm the only one that actually asks questions like, what do we mean by cause? But that's the first question that I asked. And then the question is, what are we really thinking about when we talk about financial market shocks? What is a financial market shock? Okay. So, as I mentioned that I've been working with Subra for quite a number of years. And so Subra and I have been talking about those facts and trying to develop a model that's very much in line with traditional finance models. Okay, so we're using as a starting point Grossman and Stiglitz. And to Grossman and Stiglitz, we're adding this concept of investment externalities. Okay, so in some sense there's two extensions here, or maybe one. The extension is we've got endogenous investment. I guess they don't have that in Grossman and Stiglitz. But it's a particular type of endogenous investment where the investments can be either strategic complements or strategic substitutes. And we want to look carefully at the difference between the complementary investments and the ones that are substitutes. Okay, so again, we're going to assume there's what I'm calling a participation shock, and that's something that I'm going to define a little bit more in more detail as we move along. A fundamental shock, we all know what that is. There's a shock to expected profitability, and the fundamental shock is observed by some investors, not by all investors. Okay, again, this is very much Grossman and Stiglitz, and as Grossman and Stiglitz emphasized in their paper and the literature after that, there's an inference problem. When the stock price goes up, okay, we don't know whether the stock price went up because the smart guys know that the economy is doing well. It could be that there's a participation shock that is causing market prices to go up. Okay, so hopefully this will become clear as we go along. So this is, again, the way the model works. We've got two things that ultimately affect stock prices, a productivity shock and a participation shock. The productivity shock directly affects the incumbent's cash flows. Okay, I guess I forgot to tell you, we've got two types of firms. Okay, we've got these publicly traded firms that are traded on the market. They're the old-timey firms, IBM and HP or whatever, that are paying dividends and part of our data set when we're looking at the types of issues that we look at. And we also have what I'll call emerging firms. These are firms that don't exist ex ante, okay, but if the stock market booms, these are guys that are going to go public and ultimately compete with the incumbent firms. Okay? So the productivity shock is going to be good for my incumbent firm's cash flows, okay, driving up stock prices. The participation shock doesn't affect the incumbent's cash flows directly at all, but that also will increase stock prices. But the point here is that the higher stock prices are going to make it easier for the emerging companies to raise capital, ultimately to compete with the incumbents, and that's going to have a negative effect on the incumbents' cash flows. Okay, so let's start with a world with just productivity shocks. Okay, in this world with just productivity shocks, this is really, again, our Econ 101 world. The productivity shock affects my incumbents' cash flows. That's good. That's going to increase the incumbent stock price. That's good. Okay, that's going to induce the positive correlation between the incumbent stock price and incumbent cash flows or dividends. which is what we don't observe in the market. That's going to, however, have a negative effect because that's going to make it easier for the competitors to emerge and go public, which is going to dampen the effect on the incumbent's cash flows. Okay, now within our parameters, if I have just a productivity shock, you're going to still get this positive correlation between incumbent stock prices and their dividends. Okay, so when the market price is high in this world, dividends are going to be expected to increase as well. Okay, if we just have productivity shocks. Now look at the case where we just have a participation shock. Again, for some reason, investors want to buy more stock. That increases stock prices. Okay, that increases stock prices. That feeds back into the decisions of the emerging technologies. There's going to be more investment there, but they're going to compete with the incumbents. That's going to have a negative effect on the incumbent cash flows. Okay, so if I only have a participation shock, that's going to induce a negative correlation between stock prices and future dividends. Okay, so the bottom line is when you put it all together, under reasonable conditions, you can get actually a negative correlation between incumbent stock prices and their future dividends, or it could be zero because these things actually offset, or it could be a little bit positive. But within this setting, getting a positive correlation between stock prices and economic activity being positive and stock prices and changes in dividends being even negative is not too difficult. Again, the positive correlation comes about because the stock price increase in some sense causes an increase in economic activity by the emerging technologies. It just doesn't help my incumbent firms. Okay, does that make sense? Good. Okay, so in other words, positive shocks to the stock market actually cause economic growth. It's the participation shock causes economic growth because it increases investments that are strategic complements and have positive externalities, and that's consistent with what we observe in the data, but it may not cause an increase in the dividends. Okay, the other thing, and I'll encourage you to read my paper with Subra, which we've just posted. If the variance of the participation shock is higher than expected, okay, so you get an unexpectedly high variance in participation shocks. It's more volatile than we thought. The story I like to tell is everyone went to the University of Chicago. We all learned as PhD students there that markets are very efficient and that stock returns reflect mainly changes in fundamentals and not really changes in participation. If that's what we believe, and actually the volatility of the participation shock is higher than we believe it to be, then you're going to get the result that stock prices will be more volatile than they should be relative to fundamentals, and the price-to-dividend ratio will predict future changes in stock returns in that type of world. Okay, so I'm not sure that's obvious, but hopefully you can see it in the paper. Okay, now I'd like to use sort of the license of a AFA president and try to test my model with only 2 data points. I'm going to talk about these 2 data points, and again, in fairness, I've seen other papers that basically motivate everything they've done with only one of the 2 data points. So with 2 data points, that's not so bad. Okay, so I'm going to talk about the 1990s tech boom. And the 1990s tech boom, the story there is basically my catalytic investment model within a noisy rational expectations model. Okay, actually that's the model with Subra. The model with Subra is essentially the catalytic model within the context of Grossman and Stiglitz. Okay? The second, and I think I'm going to be a little bit more cautious here because I didn't have Subra to help me on that, is the story about the 2000s housing boom. Okay, so that's the same type of inference problem that we talk about in our model, but it's within the context of a world where we worry about these pecuniary externalities. Okay, so we take the 2 models that I talked about before and try to embed them within Grossman-Stiglitz. Okay, the first one we've actually done. The second one is just me speculating. Okay. So the catalytic model, again, the internet is our catalyst that causes a tech boom. So we all know what the technology shock is. Okay, we've got the internet. We don't really know what the implications of the internet are, but we think that it's going to have a big effect on productivity going forward. Okay, the second, which we actually don't talk about as much as we should, is the participation shock. Okay, in the 1990s, okay, there was a big change in how individuals traded stocks and how people invested in general. In the 1990s, we had this onslaught of discount brokers, online brokers. Okay, that had a big influence on how people were investing. What might be even more important were sort of the death of defined benefit plans and the birth of defined contribution plans, 401ks, 403bs, and so on. Okay, the fact that I find most interesting, in the 80s, I did research on mutual funds, and there wasn't a lot of interest in mutual funds. But during the 1990s, equity mutual funds, net asset values, or the amount of assets under management for equity mutual funds, increased by close to a factor of 10. Okay, so if we talk about participation, the participation shock in the 1990s was potentially as important as the productivity shock in the 1990s. Okay, so these are things that are important. And I'm not saying that these are not observable. All I'm saying is that the implications of the technology shock and the participation shock were not well understood at the time. So we've got a big inference problem. Okay, and this was a discussion that I had with my colleagues. You know, what's causing the bull market of the 1990s? Okay, is it being caused by productivity? Is the world really getting to be more productive, and companies are going to be a whole lot more profitable as a result, and that's why the stock market's booming? Or is it because of this participation shock? Is it because individuals are buying more stocks, pushing prices up? Okay, we really didn't know at the time. If we knew at the time that it's a participation shock, then we'd say markets are too high. We would probably allocate less. Okay, if we know it's a productivity shock, we're going to allocate more. The fact of the matter is that we don't know for sure. Okay, so that's the type of inference problem we have. Okay, so if that's the case, and let's again suppose that investors underestimated the magnitude of the participation shock, okay, then again, these guys all went to the University of Chicago. They believed that the stock price run-up reflected cash flow news rather than what they'll call discount rate news or increased participation. That, of course, is going to lead to higher stock prices that eventually revert. It's going to lead to increased investment in emerging technologies, and it's going to lead to good things in some sense. The increased investment in these technologies that are strategic complements, okay, these are going to be technologies that in the absence of the boom, we would have underinvested in. Okay, so that's a case where we've got a boom, some might call it a bubble, whatever you want to call it, prices are higher than fundamentals. That's good for the economy because it stimulates the investment in strategic complements. So you're going to get a positive association between the stock market boom and aggregate economic activity, but you're going to have a negative effect on the ultimate profitability of the incumbents. Okay, so again, one data point. Am I going the wrong way? Yeah. Okay, second data point. The second data point is the mid-2000s credit boom. Okay, the fundamental shock, okay, and this is something I had to actually read to remember. There was something that people called the Great Moderation. Okay, this is interesting. This actually came from the title of a talk that Ben Bernanke gave to some economic association, talking about the fact that, you know, we sort of solved the problem. We know how to deal with macroeconomics. We know how to offset, you know, fluctuations in the business cycle. So as a result, the economy is much more moderate going forward than it was in the past. In Robert Lucas's presidential address in 2003, he doesn't use the word great moderation, which was Bernanke's term, but he said the central problem of depression prevention has basically been solved. Okay, so we know that volatility in markets were reduced, and we also know that credit spreads narrowed at around this time. Okay, so the story that some were telling was it was because of the Great Moderation. Okay, that's the fundamental shock. Okay, what's the participation shock? Well, we all know that there was an emerging market savings glut at around the same time. Countries like China and other Asian countries, they were saving a lot, and they were investing in U.S. debt. Okay, so there's a big flow from Asia to the U.S. into the U.S. debt markets. So a glut of savings into our debt markets. At the same time, we had financial innovation that could transform BBB debt, like mortgages, into AAA debt. So we had this new magic that allowed us to reduce the supply of BBB debt, increase the supply of AAA debt right when we had a lot of people from Asia wanting to buy that AAA debt. So you could tell the story of a participation shock again that had the effect of greatly reducing credit spreads. Okay, so again, it's the inference problem that we always have. We see the reduction in credit spreads. Okay, I've got some people that are saying it's caused by the Great Moderation, and others are saying, no, it could be this participation shock. Okay, as an uninformed investor, we don't really know which is which. Okay, it's going to affect our investment decisions. If we knew, we would invest differently, but we don't know. Our priors on the efficiency of markets, which would be equivalent to our priors on the volatility of the participation shocks, going to affect our decisions. Okay, so again, suppose that investors underestimated the magnitude of the shock to credit supply. Okay, then they would believe that the credit spread reduction reflected reduced uncertainty. Okay, that's going to lead to tighter credit spreads. Okay, it's going to lead to a higher value for collateralizable assets. Okay, so things like houses that are financed through credit, their values will increase relative to assets that cannot be financed with debt. So debt capacity is going to affect how this participation shock affects assets. You're going to get increased investment in those collateralizable assets. And as I mentioned, you're going to get unfortunate consequences from the resulting pecuniary externalities. Okay, so that's the story. I'm not going to spend a lot of time on completing the story, but I just wanted to mention that it's fairly obvious that this second story is going to require a little bit more hand-waving at the least, and perhaps a model itself that's going to explain why the Modigliani and Miller theorem doesn't hold. Obviously, if M&M holds, it doesn't matter whether we get a shock to debt markets versus equity markets. Okay, but if M&M doesn't hold, and there's a lot of reasons why it doesn't hold, okay, then there's going to be a big difference between a shock to a debt market and a shock to an equity market. Okay, they're going to affect investment differently. And my argument here is it could affect investment differently in a way that's quite interesting, because the shock to the equity markets are going to affect the types of investments that are strategic complements, while the shocks to the debt markets are going to affect investments in these assets that have this pecuniary externality type issues, the strategic substitutes. Okay, so shocks to debt markets and shocks to equity markets are fundamentally different in a world where M&M doesn't hold. Okay. So just briefly summarizing, emerging technologies tend to be strategic complements, okay, which is going to imply underinvestment. They require equity financing. Things like real estate and capacity expansions tend to generate pecuniary externalities, implying overinvestment. These are investments that can be financed with debt. So therefore, shocks to debt and equity markets have fundamentally different consequences. Okay, so just some concluding thoughts. I mentioned at the beginning that I started thinking a little bit about policy. It's obvious when you think about policy, you've got to think about externalities. I think we need to think more carefully about real investment externalities. The other thing just to mention is, again, we've got to think about this inference problem and the consequences of mistakes made by rational investors. Again, there's a behavioral twinge here, but these aren't irrational investors. They're just rational investors that happen to make mistakes, and that these mistakes can have consequences. And the point here is that the implications of these mistakes actually can look a lot like behavioral biases. And one thing that I just want to stress is that we've sort of had two camps in this profession. One camp saying people are rational, we have efficient markets. Another camp is relying on the psychology literature to talk about behavioral biases. I just want to suggest that there's a lot in the world that's complicated where rational people make mistakes. And in these types of models, having rational people having priors that aren't quite right about things like the volatility of the participation shock will give you results that are observationally equivalent to the behavioral models. Policy-wise, should policymakers offset the participation shocks? I think if they observe them, obviously they do. They should do that. The thing that I want to emphasize more in terms of policy, and this is something that came up a lot at the 2008, 2009. Some people were saying, gee, financial economists should have been able to foresee this collapse that was going to happen. And our answer was, well, in efficient markets, we can't foresee what's going to happen in the future. That's the whole point of these markets. We can't have a theory where I know what's going to happen in the future and I can, in some sense, do something about it. But the point here is that there are observables that are related to what I call the fragility of markets. And even though we can't predict the direction of the market, we should be able to predict instances where, because of the complementarities, that we have some sort of fragility, and there may be policy implications of that. Thank you very much.
There's one final piece of business tonight. I'd like to present to Sheridan this plaque as a small token for the association's great appreciation for his service over the past 3 years as vice president and then program chair and president. Sheridan, thank you. And with that, we'll adjourn.